Welcome to Lecture 3 of our Payments course. Today, we'll be discussing two vital components of the payments ecosystem: merchant accounts and acquiring banks. These elements form the backbone of any business's ability to accept payments, and understanding how they work is key to setting up a secure, efficient payment system. By the end of this lecture, you'll have a solid understanding of what a merchant account is and why businesses need one, the role of acquiring banks in processing payments, how acquiring banks and merchant accounts work together, common types of merchant accounts and their benefits, key considerations for businesses when choosing an acquiring bank or merchant account provider. Let's get started! What is a merchant account? A merchant account is a type of bank account that allows businesses to accept payments, primarily from credit and debit cards. When a customer makes a purchase, the payment does not go directly to the business's regular bank account. Instead, it first goes into the merchant account, where it is processed, verified, and temporarily held before being transferred to the business's main bank account. Definition: a merchant account is a specialized business account set up with an acquiring bank or payment processor, which is used to receive funds from payment transactions. These transactions are mostly card-based, but merchant accounts can also support other payment methods like direct bank transfers, mobile payments, and digital wallets. Purpose: merchant accounts are necessary for businesses to process payments securely and ensure that funds are handled according to regulatory and industry standards. Without a merchant account, businesses would be unable to accept credit card payments directly. Key functions of a merchant account: processing payments. A merchant account allows businesses to accept and process a wide variety of payment methods, including credit and debit cards, mobile wallets, for example, Apple Pay, Google Pay, and other online payment methods. Holding funds. When a customer makes a purchase, the funds from the transaction are temporarily held in the merchant account before being transferred to the business's main bank account. This holding period allows for checks, such as fraud detection, to be carried out. Settlement and reconciliation. The merchant account facilitates the settlement process, ensuring that funds from successful transactions are deposited into the business's account after processing fees are deducted. It also helps with transaction reconciliation, where the payments received match with the orders placed. Refunds and chargebacks. Merchant accounts also handle refunds, where businesses return funds to the customer, and chargebacks, where a customer disputes a transaction and requests a reversal. Merchant accounts help businesses manage these processes efficiently. What is an acquiring bank? An acquiring bank, also known as an acquirer, is a financial institution that partners with merchants to process card transactions. The acquiring bank acts as the bridge between the merchant, the payment processor, and the customer's bank, known as the issuing bank. Definition: an acquiring bank is a financial institution that processes card payments on behalf of a merchant by receiving transaction data, forwarding it to the card networks, for example, Visa, MasterCard, and communicating with the issuing bank for approval. In other words, the acquiring bank ensures that when a customer swipes their card, enters their details online, or taps their mobile wallet, the payment is authorized, processed, and settled correctly. Key functions of an acquiring bank. Merchant account provider. Acquiring banks often provide merchant accounts to businesses, enabling them to accept payments. The acquiring bank manages the merchant's account and oversees the payment process, from authorization to settlement. Transaction authorization. When a payment is made, the acquiring bank sends the transaction details to the card network, Visa, MasterCard, etc., and then to the issuing bank, the customer's bank. The issuing bank checks the customer's account for available funds and fraud risks, then either approves or declines the transaction. Settlement and clearing. Once a transaction is authorized, the acquiring bank facilitates the transfer of funds from the issuing bank to the merchant's account. This process is called settlement and typically takes a couple of business days. Risk management. Acquiring banks play a vital role in managing risks associated with fraud, chargebacks, and disputes. They monitor transaction activity for suspicious patterns and help merchants comply with security standards like PCI DSS, Payment Card Industry Data Security Standard. How merchant accounts and acquiring banks work together. The relationship between a merchant account and an acquiring bank is critical to the successful processing of payments. Let's break down how these two entities interact. Customer makes a payment. The payment process starts when a customer makes a purchase, whether in-store or online, using their credit or debit card. Payment gateway transmits data. A payment gateway, which we covered in the previous lecture, captures the customer's card information and securely transmits it to the acquiring bank. Acquiring bank requests authorization. The acquiring bank sends the transaction details to the relevant card network, for example, Visa, MasterCard, which then forwards the request to the customer's issuing bank. Issuing bank authorizes or declines. The issuing bank checks the customer's available funds and performs security checks to detect any potential fraud. If everything looks good, it approves the transaction. If not, it declines the payment. Funds settled in the merchant account. Once the transaction is approved, the acquiring bank settles the funds. The money is first deposited into the merchant account, where it is held for a short time, usually between 1 to 3 business days. After any fees are deducted, the funds are transferred to the business's main bank account. Merchant receives the payment. Finally, the business receives the payment in its regular bank account. The merchant can now use those funds as needed. Types of merchant accounts. There are several types of merchant accounts tailored to different types of businesses and their specific needs. Let's look at some common ones. Retail merchant accounts. These are designed for businesses with physical locations such as retail stores, restaurants, and service providers. Transactions are typically processed via point of sale, POS terminals, or card readers. E-commerce merchant accounts. E-commerce businesses need merchant accounts that support online transactions. These accounts work closely with payment gateways to ensure secure payments via websites, apps, and other online platforms. High-risk merchant accounts. Some businesses, such as those in gaming, adult entertainment, or travel, are considered high risk by banks due to higher than average chargeback rates or fraud risk. High-risk merchant accounts come with stricter terms, higher fees, and additional compliance requirements. Mobile merchant accounts. Mobile businesses, such as food trucks or freelancers, often use mobile merchant accounts. These accounts allow payments to be processed via mobile card readers or apps, enabling businesses to accept payments from anywhere. Subscription-based merchant accounts. Businesses with subscription models, such as SaaS platforms, need merchant accounts that support recurring billing. These accounts enable businesses to automatically charge customers at regular intervals. Choosing the right acquiring bank and merchant account provider. For businesses, selecting the right acquiring bank and merchant account provider is a crucial decision that impacts their ability to process payments efficiently and manage costs. Here are a few factors to consider. Fees and pricing structures. Acquiring banks and merchant account providers charge various fees, including transaction fees, a percentage of each sale, monthly account fees, setup fees, chargeback fees. It's essential for businesses to compare pricing structures and choose a provider that aligns with their budget and transaction volume. Payment methods supported. Different providers support various payment methods, including credit, debit cards, mobile wallets, and alternative payment options, like buy now, pay later services. Businesses should ensure their provider supports all the payment methods their customers use. Security and fraud prevention. Since fraud is a significant concern in payments, acquiring banks and merchant account providers should offer robust security features such as encryption, tokenization, and fraud detection tools. They should also be compliant with PCI DSS to protect sensitive customer data. Customer support and service levels. Payment issues can happen at any time, and having reliable customer support is essential. Businesses should look for providers that offer 24/7 support, fast response times, and assistance with technical issues or chargebacks. Integration with existing systems. For businesses with existing point-of-sale systems or e-commerce platforms, choosing a provider that integrates seamlessly with their current setup is critical. This ensures smooth payment processing without the need for major system overhauls. Global capabilities. For businesses operating internationally or planning to expand globally, working with an acquiring bank and merchant account provider that supports multiple currencies and cross-border transactions is a must. The importance of acquiring banks and merchant accounts in the payments ecosystem. The relationship between acquiring banks and merchant accounts is vital for businesses to accept payments seamlessly and securely. Without a merchant account, businesses cannot access payment networks like Visa or MasterCard. And without an acquiring bank, businesses cannot process card payments or settle funds efficiently. For many businesses, particularly those that rely heavily on card payments, choosing the right acquiring bank and merchant account provider is one of the most critical decisions they'll make. It impacts everything from cash flow and security to customer experience and business growth. Key takeaways. Merchant accounts are specialized accounts that allow businesses to accept and process payments, including credit and debit cards, and temporarily hold funds. Acquiring banks partner with merchants to process card transactions, handle authorization requests, and settle funds. Acquiring banks and merchant accounts work together to facilitate smooth and secure payment processing for businesses. There are different types of merchant accounts tailored to different industries and business models, including retail, e-commerce, high-risk, and subscription-based accounts. Businesses should carefully choose acquiring banks and merchant account providers based on fees, security, payment methods supported, and global capabilities. Feel free to reach out if you have any questions, and I look forward to seeing you in the next session.